Good morning, everybody. It's Curtis back with another investment video. First of all, I want to say a big thank you to everybody that subscribed to the channel of late. I produced a video just over 24 hours ago about ETFs, and around that time I was around 240, 245 subscribers, now sitting at 262. So thank you to all of the new subscribers that have joined the journey. If you're new to the channel and this is your first video, your first view to Infinite Investors, it's a channel that's focused on helping new and non-investors make sense of the stock market. I tend to produce videos on a wide array of topics, and the Profit Podcast is about, a whole bunch of different topics or different types of investing. The Fundamentals is a new series about fundamental data and analysis that you might want to take if you're a value investor. My personal free trade journey is I believe in educating through demonstrating. So rather than giving a whole bunch of theory, I think it's valuable to kind of show people, what trades I'm specifically doing, and using that as a mechanism to kind of help and support people. I do stock market news, so if there's something that's happening in the news that might be of importance to you guys, I will do videos on that. And then previously I've had sort of an animated series about different asset classes and so forth. So, I'll always add to the playlist. There'll be more playlists as well coming up. And so if you want to learn about the stock market, if you want to understand, different aspects of the stock market, that's what I'm sort of here to do, and that's the sort of purpose of the channel. Now, my next goal is 500 subscribers. I want to try and hit 500 subscribers by the end of the month. I know it's a tall order, but as the saying goes, shoot for the moon and you'll fall somewhere among the stars. I think it's really, really crucial to set yourself goals. I find it quite ironic that in a lot of establishments that we grow up in, whether it's education or whether it's work, we're set targets. Now, that tends to benefit the establishment more than it benefits us. Sometimes it does benefit us. Let's say if you're at school, you're set a target to try and get an A or a B or whatever the grade is. It's good for yourself because you want to get high grades, but at the same time, it generally benefits the school because they can apply for more funding, because they can say that their students are outperforming their region or their type of school, or etc., etc. When you go to work, whether you work in customer service or sales or retail or product or marketing or finance or technology or whatever department you work in, you're generally set what's called a KPI, a key performance indicator. And again, you might get some bonus that's sort of interlinked or tied with that. You might get a pay rise or salary that's tied with that, but typically it's fractional compared to what the business will benefit from, what you sort of deliver for them. And then when it comes to our home lives, we generally don't set ourselves targets and goals. Now, for the most part, that might be perfectly fine. If you go to the gym and you exercise, you might want to set yourself, exercise goals and target, whether it's, getting yourself down to a certain weight or, increasing your certain weight or muscle, etc., etc. There might be, other aspects in life where you might want to set yourself a target, which makes sense. I think when it comes to investing, I don't think it just makes sense to set yourself a target. I think it's actually crucial. I think if you don't set yourself an objective and you don't set yourself a strategy when it comes to investing, you can really quickly get lost in the current, in the tide, and potentially lose a lot of money, which obviously isn't going to be a good feeling. So if you set yourself a target and goal, what I think it does, it helps you, focus on what's important in order to help you achieve that target and filter out all of the noise. Now, I do think it's very, very difficult for new investors specifically to try and set yourself a target when you don't even know, what type of investments there are out there and where to sort of begin and where to sort of start. And that's the purpose for this video. This video is about understanding the different types of investments and different types of investors, so that you can kind of work out, you can look internally, look within and work out based off your personality, based off your lifestyle, based on, the stuff that's important to you, what is your investment style, and therefore you can kind of focus on what needs to be focused on, filter out all of the stuff that can be filtered out, and hopefully have a more productive and a better chance of reaching your investment goals. You can also then set goals that are more reasonable to what you're trying to achieve. In this graph that you can kind of see in this video here, this is the kind of thing I was trying to convey. Actually, it probably wasn't really clear, but some investors, you all can kind of reach roughly the same goal, but you might have a different journey effectively that sort of gets you there, and that's the kind of symbolism in this graph, in this sort of cover art. And that's what I'm going to sort of talk to you about today. So there are three different types of investors. and there's two approaches to investing. Now, the two approaches can kind of converge with any one of the types of investing, but some are more suited to others. But yeah, I'm going to sort of get into that, and please get in the comments after the video, and let me know what type of investor you are, and it'll be good to kind of talk through with you that, and if, whatever stocks you're looking at, if that's suitable, etc., etc., etc. So there are three different types of investors. The first one is an income investor. So this is an investor that's typically focused with dividends. Dividends is your main priority, your main focus. Now, you're focused on things like the dividend payment, the dividend yield, the dividend cover. Has the company consistently paid a dividend? Has the dividend increased over the X amount of years? You're typically looking for safe organizations that pay a dividend, whether it's quarterly, monthly, biannually, etc., etc. Excuse me. And so with dividend investors, you generally will go for safe, well-established stocks. So these are stocks such as the BPs of the world. It'll be stocks such as Coca-Cola, etc. So stocks that are companies that have been around for hundreds of years and will continue to be here for hundreds of years. Companies that continuously earn money. They're not going to grow significantly because they dominate whatever market that they're in currently at the moment. So really and truly, they are the leading organization or the leading company within that sector. And so really and truly what they try to do to gain investment, they pass those profits back to you guys as investors. Now, of course, dividend investments may not grow at the same rate of sort of value or growth rate. However, what a dividend investor's focus generally is the compounding effect. So the way they look at it is, if I invest in a safe stock that pays a really good dividend, or multiple stocks that pay really good dividends, then when those dividends come in, I'm going to reinvest those dividends. And then when those dividends come in, I'll reinvest those dividends. And that cycle is a rinse and repeat cycle. And if they continue to do so, effectively, the compounding effect of all of the returns that they've made will actually then grow their investment quite considerably over the long term, the long period. So that's the way that they achieve growth, by sticking with safe companies that pay a good dividend, and then they reinvest those dividends in order to achieve the growth in the long term. So there is a method as to reason why people are dividend investors. And going along my journey, I've met so many dividend investors and been really, really impressed with the way they kind of approach investing. The next type of investor is probably the type of investor that I would align myself with, which is a value investor. It's the kind of Warren Buffett-esque approach. Now, the Warren Buffett-esque approach is effectively looking at safe, established companies, but really and truly, your primary focus is finding companies that are undervalued. And the reason why you find companies that are undervalued, it might be through some turmoil within the organization. They might have changed CEO. They might have introduced a new product line. They might have just got rid of a new business unit, or an old business unit rather. A new competitor might have come into the market, which has kind of disrupted their profits and their earnings. They might have had a legal scandal. It could be a whole array of things that have actually caused the business to, for whatever reason, be underperforming their intrinsic value. But what your sort of focus is that that they're currently underperforming, and that is an opportunity to buy more stocks. And that's an opportunity to buy because you know that the intrinsic value will mean that the company will rise. It will rise to their intrinsic value, and it might actually surpass it. And by doing that, you then gain a considerable amount of growth by taking that approach. Now, value investors any company can kind of fall under the value ecosystem, because any company could be undervalued at any given time during their company life cycle. But I think with value investors, they tend to be safe as well, because the whole point is that they've got a good track record. And so what we're trying to do is find stocks that are going to return back to their existing track record. So they may pay dividends, they may not pay dividend. It can kind of all depend on the company itself. But as an investor, you generally look at their fundamentals, their asset, their debt, the PEG ratio, their earnings per share, their PEG growth ratio, their forecasted earnings, their projected earnings, and what's going on with the business. And then you sort of make an informed decision of if you should invest and if there's opportunity for that stock to sort of grow. Then you have growth stocks. Now, growth stocks tend to be companies that have a very, very high possibility or a high potential for growth in whatever time period that you're looking at. These companies generally don't pay a dividend. You might have some growth stocks that do, but generally speaking, they don't. The reason why is because they'd rather use their earnings, use their profit, use their revenue to re-inject, reinvest back into the business, whether it's opening up a new product line, a new business unit, investing in new technology, whatever the reason is. But by reinvesting back into the business, they can further supercharge that growth. By further supercharging that growth, their share price can increase as more people invest. And then at some stage in the future, if you got in at a good time, you can then sell and make a tidy profit. Apple was a prime example of that. Apple is an organization that if you invested early on and then you sold after 3 years, you would have made, if you invested 10K, you would have made 25K. And that's the type of, growth. That's the type of, I guess, return growth investors are kind of looking at. They're trying to double their money, maybe even go further than doubling their money, etc. Growth stocks tend to be stocks like Tesla, Amazon, Facebook, Google, the FANG stocks, the Netflix, etc., etc. But they also might be new entrants. So it could be, a lot of the time it's technology companies. It's not exclusive to technology companies, but I would say that if you're a growth investor, 90% of the time, please correct me if I'm wrong, but 90% of the time, 95% of the time, you're looking at a technology company. You're looking at a company that's entered the market, really trying to disrupt things and has a high propensity to grow. So when we think about IPOs, Lyft, Uber, Stripe, Slack, Airbnb, Pinterest, whatever, you're thinking that when they come into the market, they've got a high chance to grow. Now, a lot of the time with growth stocks, they're typically making a loss. A lot of the time they're not even making a profit. A lot of the time they're in a lot of debt. Take Lyft as an example, has never made a profit, and forecasts say that they will never make a profit. Now, with my business hat on, a business that never will make a profit is just something that I personally wouldn't invest in. But maybe a growth investor will see some opportunity at some stage in the future. Maybe they think that Uber will acquire Lyft, and if they do so, then Lyft shares will skyrocket, and that's an opportunity that could well possibly happen. And so, you're thinking that there's opportunities to come, and you're not potentially going to be bogged down with the fundamentals. So you're not saying that, okay, their PEG ratio might be high, their PE ratio might be high, their debt might be high, their assets might be low, but you're not really worried about that. You're kind of thinking, okay, I don't care about all of that. I think they're going to have a high chance to grow in the future, so I'm going to take this risk. I'm going to kind of speculate and see what sort of happens in that aspect. Netflix, as another example, is an organization that's £25 billion in debt. It's a considerable amount of debt. Now, obviously, the reason why they're in debt is because they have low subscription fees in order to gain a bigger market share. Their focus was trying to gain a market share, not just on a national level, but on an international level. But also, the introduction of Netflix originals means that they spend so much on the production of content. Just look at some of the deals they've done with some comedians, where they're giving them £55 million for 2 specials, or £50 million for like 1 special. These are considerable amounts of money that they're spending, so that their subscribers stay on the platform and continue to pay and consume. Now that kind of works to an extent where you've got, they've released figures that says the average retention rate for a Netflix subscriber is like 7 years, whereas with most companies it's like 7 months or something, like considerably much smaller. So they are retaining customers, but they're obviously looking at ways that they can grow. But I do think when you have that amount of debt, it potentially is quite a risk. People that got in early have probably already profited. There's probably still growth with Netflix. I think Netflix is a bad example in terms of a company that may not grow. I think Netflix will still continue to grow. They will have challenges such as Disney entering the market, etc. But they've probably got smart enough people to work out how they can kind of manage that risk. But yeah, that is typically the Teslas, the Netflixes. Those are typically what you would consider a growth stock. So when you're on the stock market, or when you're sort of watching stock market news and you're sort of seeing that this is dropping, or that's rising, it's good for you to kind of just focus and hone in on ones that are most important to you, so you can kind of filter out the noise and focus on what's relevant. Now, with all of these types of investors, there's two types of approaches to investing. I'm going to put these links in the description. Now, the two types of approaches is active investing and passive investing. Active investing is the type of investing that I do, which is that I look at my portfolio on a regular basis. I try and work out, what's happening, how is it performing, is it still undervalued, is it overvalued, are they paying a dividend, when are they paying my dividend, is it underperforming, should I sell, should I buy, what other ones should I continuously bring? You're really sort of managing it like it's your own fund, etc. A passive investing style is more that, I'm going to give 10k to this ETF or to these bunch of stocks, and I'm just going to forget about it, and I'm going to come back and check up on it in a couple of years time or in a year's time, etc. Passive investing suits people that, you may have a really sort of great quality lifestyle, whereby you don't really want to sacrifice your lifestyle to try and earn a few extra percentage on your performance, or you're not really trying to beat the market. You might be more interested in football or art or beauty or makeup, or you might be into like your school or your education, or really into your job or whatever career that you've got. And so you know that you need to invest, that it's wise to invest, but you want to just put your money away, invest, and let it run so you can focus on the important things in your life, which I completely appreciate and respect. Passive investing is similar to real estate. So, when you buy a property, you don't go and check the property value every month, or, how much is it now, because you're not going to sell it. So there's no point checking every month. You might check it every year or every sort of 18 months, etc. But you're not going to check it sort of every day to see what is the price or the value of your property. So taking that same approach and that mindset and that thinking to the stock market is effectively what a passive investor will do. An active investor is someone like me who's a little bit more OCD. I like the stock market, I'm passionate about the stock market, and I really want to see what's happening so that I can become a better investor. My goal is to become a better investor. So it doesn't mean that I have, absolute, crap life, that I'm not interested in anything else. There are absolute other things that I'm interested in, that I'm passionate about, but I'm also equally passionate about the stock market. So I'm happy to devote a portion of my life to becoming a better investor, because I think that's going to benefit me, my family, and hopefully you guys that are subscribed to the channel, etc. So it's worth working out, are you a passive or are you an active investor, and then working out, are you primarily focusing on high growth stocks that don't pay a dividend, value stocks, or trying to find a stock that's undervalued, that's a bargain, or income stocks, so stocks that are safe, focusing on a dividend. When you kind of work out what's your best style and what you're best suited to, Simply Wall Street is a great tool to try and sort of find stocks that are catered to your portfolio style. So, based off the stuff that I've purchased, it will tell me to explore ideas based off this portfolio. When I click on that, it gives me stocks that I could potentially buy that are very similar to the ones that I'm currently getting. So that is a very good way to kind of source stocks that are based off your style. Let's say, for example, I'm a dividend investor. The same applies. I can scroll down to the dividend section, and so if I'm a value investor, I can explore undervalued companies tailored to this portfolio. I can also, if I'm a dividend investor, I can explore dividend players that are tailored to this portfolio, etc., and find dividend players. So this is the reason why I use Simply Wall Street. I think it's great at managing portfolio. I think it's great at evaluating stocks. It makes things easy. And I also think it's great at then discovering new opportunities and new stocks that will help you, find things that are relevant to you and kind of filter out the noise of the stuff that aren't sort of relevant. I really hope this video was insightful, but get in the comments, let me know what type of investor you are. Are you active? Are you passive? Are you focused on growth, income, or value? We can talk about the type of stocks that you're selecting or you're looking at, etc., etc. But yeah, get in the comments. On a mission to get to 500 subscribers, which I'm really, really delighted to say. Again, a big thank you to everyone that's been subscribing. And if you've got to this level of the video and you haven't subscribed, then please hit that subscribe button. If you don't know what to do that because you're new, make that like button go blue. Please get in the comments so other people can see if the video is valuable. And I will catch you next time. Got a lot more videos to come over the next few weeks, so stay tuned, and happy investing.